Donald Trump has upended the world order, and it's not clear what will take its place. In the inaugural Vantage Point essay from Australia Institute Press, Dr. Emma Shortis examines the future of our alliance with the United States, which all too often makes us less safe and not more. You can order your copy of After America, Australia and the New World Order now, or you can become a foundation subscriber to Vantage Point and save 25% on an annual subscription. Find it at australiainstitute.org.au/store or via the link in the show notes.
Wealthy and the vested interest groups are a bit worried that people might look at actually just how bad the system is. Go, oh, yeah, we can't tax unrealised capital gains. Why? What's happening with capital gains? Oh, my God. 80% of the benefits of capital gains are going to the richest 10%.
One for mum, one for dad, and one for the country.
And there has never been a more exciting time to be an Australian.
Budgets are about choices, Fran, and you show what you value through the choices you make.
This is coal. Don't be afraid. Don't be scared. The Treasurer knows.
I want an economy that works for people, not the other way around.
We'll just end up being a third-rate economy, a banana republic.
Just follow the money.
Hello and welcome to Follow the Money, the Australia Institute's podcast which explains economics, politics and policy in plain English. I'm Glenn Connley, Senior Media Advisor here at the Australia Institute. Today we're talking about retirement, superannuation, the age pension, the tax we pay or don't pay on our super. In its first term, the Albanese government proposed changes to the superannuation tax concessions.
And today I'm announcing that earnings on super balances above $3 million will have a concessional rate of 30%. rather than 15%.
Australians will see this change as modest and reasonable and fair.
I think this is really sensible. If you have a few $1 million tucked away in super, I don't understand why you should continue to get really generous tax concessions.
It's not a new tax, just a change to the concessions for the very wealthiest Australians. But the response has been hysterical, bordering on bizarre.
This has overtaken inheritance tax in my list of the world's worst taxes. And yes, I do have a list in my back of my mind.
The political cost is now the trust issue that you're alluding to. Are you going to apologise to the Australian people?
People work hard for this money, and at a time when they're struggling to pay their bills today, the Labor Party seems dead set on making it harder for people tomorrow.
It's obviously going to cause people to have to sell assets if they don't have the cash.
It'll destroy some people's lives.
Some in the coalition and a few conservative business columnists seem to think defending multi-millionaires is a hill worth dying on. The bedwetting on this one is mind-boggling. Joining me today to talk about it is Greg Jericho, Chief Economist here at the Australia Institute. G'day, Greg.
G'day, Glenn.
I reckon a pretty good place to start here is the very beginning. Why do we have a superannuation system in Australia?
Yeah, basically it was Paul Keating, his idea, and it had been one, certainly if you see his doco, he'd been thinking about for a while, was to try and get superannuation away from being the purview of the elite and the managerial class and the CEOs and all the people who are a member of the Melbourne Club and all these things. They were getting super through their own ability to fund themselves, whereas your everyday worker was not able to do such things and were basically sentenced to life on the age pension when they retired. And so, coupled with a few other things that were going around, including some tax changes and also concerns about the fact that Australia wasn't saving a lot of money, they brought in the superannuation guarantee, which, as we know, takes out a percentage of our wages, essentially, locks it away in superannuation, accrues income over that time, so that when we retire, hopefully, if all goes to plan, we're not as dependent on the age pension. That was the initial view. If we get everyone saving, then when, especially the baby boomers and everything, when they retire, they won't be on the age pension, so the government won't have to pay out so much money for the age pension, and we'll all be a lot better off because we've been making use of compound interest and all these wonderful things, and it'll be retirement nirvana.
And I guess to make it attractive, it was low taxed.
Yeah, I mean, this is the key thing about that we're dealing with today. There's a number of superannuation tax concessions. One is on the contributions, when you're actually putting money into your super instead of it being taxed like it was your income. it's taxed at 15%, which is pretty much lower than what anyone is paying for any of their income tax. And certainly if you're very wealthy and you're earning over $190,000, you're on a 45% top marginal tax rate. So 15% is a sweet deal. And also there's taxes on the earnings. They're also at 15% rather than, again, at 45, 37 or 30%. Why they do that, though, you think, oh, God, why are we giving tax breaks to people? It's because it's designed to encourage you to actually save, and also because, in effect, that money's been taken away from you, can't access it until you retire. It would be kind of unfair to say, oh, we're actually going to tax you, but you can't touch that money. It's just like the way it's like there should be an incentive to have people say, actually, this is a good thing that I'm saving for my retirement. I'm actually getting an encouragement to do so because I'm getting a bit of a tax break. That kind of, in theory, is a good idea because it encourages people to save. Problem is, it's a good theory, but accountants look at it and go, there's a good tax practice at avoiding tax.
So how did we go then from some good tax breaks as an incentive to a lot of wealthy people now use super as a tool to reduce the amount of tax they pay?
You think about it in terms of who can afford to put extra money into super. Now, if you're on the minimum wage or if you're even on medium wage at 60 grand, you're not exactly finishing your spending at the end of the week and go, gee, I've got a couple of hundred lying around that I can't think of it in the day. I'll put it in my super. You don't actually have that much left over. If you're really wealthy, though, and especially if you're getting close to retirement, so you're at a point where your kids have left home, you probably paid off your mortgage, you actually do have a lot of money lying around. And it's like, well, your accountant's saying, well, why are you putting it in the bank or something where you're actually, if you're earning interest in a bank account, you get paid as though it's income tax. Put it in your super and you get 15% tax rate instead of your highest marginal tax rate. And also you're not getting taxed on the earnings as the value of your portfolio goes up. So what has happened is this incentive has become actually an ability for very rich people especially to avoid paying tax. And this also comes back to, okay, why did we set up the superannuation, as you asked in the start, and why do we have these benefits? It's because we wanted people to be able to save so that when they retire, they're not relying on the age pension. Now, if you're in the richest 10%, I'm sorry to tell you, you are never going to be on the age pension because you wouldn't be eligible because you would have far too much income, far too many assets. You wouldn't have qualified for the age pension. So those people are getting the benefit of a tax break designed to help them not be on the age pension when they were never going to be on the age pension. So in effect, it's just a tax break. And that's where we really start finding problems.
Let's be very clear about this. They haven't been upfront with the Australian people.
To begin with, it was a broken promise. Labor said going into the last election that there would be no changes to tax, no changes to superannuation.
We have deliberately said that we will take this to the people. This policy doesn't start until after the election. It leaves 99.5% of people completely unaffected. And so these changes have been in the public domain now for more than 2 years. They've been in the Parliament for a big slice of that. We've made it clear that these changes are relatively modest, but they're important in the context of the budget.
I'm keen to work out how we arrived at the figure of 3 million, but first of all, tell me what these proposed changes are all about that were proposed in the first term of the Albanese government and we're told will be introduced quite soon to Parliament.
There have been multiple reviews into superannuation because everyone realises, and both sides of government realise, that the cost of these tax concessions is just ballooning. It's going up exponentially, and that's kind of revenue that is lost to the government. So what happened in the government's first term was they proposed changes to superannuation. Some of them were technical, changing sort of the definition of what superannuation is. They proposed these changes to how superannuation was taxed, but also because they'd kind of gone to the previous election saying we're not going to do anything, They flagged that they'll bring in these tax changes, but they said they will not come into effect. They won't be voted on until after this most recent election. So in effect, they were not breaking election promise, and they're saying, look, we're taking this to the next election. So what the changes are, as I was saying, at the moment, your tax on your earnings in your super are taxed at 15%, which is a nice tax concession if you're someone who's earning over $190,000. It's effectively a 30% tax break. What they're going to do is for super funds with more than $3 million in that fund, the earnings are going to be taxed at 30% rather than 15%. That's still lower than 45%, so it's still a tax concession. It's just not as big a one. But crucially, the tax will only apply to the earnings that are attributed to the amount of your fund over $3 million. In effect, everything up to $3 million, nothing changes. It's only on the amount that can be attributed to having more than $3 million that gets, you can either say gets taxed at a higher rate, or another way to put it is gets less of a tax break, but still gets a tax break.
If you knew that there was someone out there who had $400 million in their superannuation account, I didn't. If you knew that there were 17 people who had $100 million in their account, I didn't. And it's hard to argue that those levels is about actual retirement incomes, which is what superannuation is for.
Look, I'm about 20 years away from retirement, and I've only just started to go into my super account, and it tells me what I might need to retire. Invariably, it asks me how much I want each year of retirement, which is a pretty hard question to answer. How did we get to 3 million? Who decided 3 million was the amount before we really should start taking a little bit more?
Look, there is absolutely zero science behind this, because you're right. If you go to things like the Association of Australian Superannuants, ASFA, I forget what it's called, they'll say for a comfortable retirement, which is something where every 5 or 6 years you're able to go on an international holiday, you're able to do one domestic holiday a year, you got a nice car, you never have to worry about your heating bill or your air conditioning bill, you can go out to a restaurant fairly regularly. In other words, a pretty comfortable lifestyle. You're not, you could have all your internet and streaming services. To do that as a single person, you need about $595,000 to retire. Now, that is actually quite above what is the median superannuation balance, but let's just say $595,000 is what we're after. So you might think, how'd they come up with $3 million? Look, to be honest, I think the government basically chose a number that seemed so absurdly high and affected so absurdly few people that they thought, who's going to complain about this? Because 3 million, when the government proposed it, they were looking at the most recent sort of tax numbers and numbers of funds, and it seemed about 80,000 people had more than $3 million in their super, which is about half of 1% of everyone with the super account. So we are talking not even the richest 1%, we're talking the richest 0.5%. And that's pretty much it. There was no sort of, there's no calculation of, this is the precise point at which we should start doing anything because it's it was a political decision of 3 million sounds pretty safe, free from criticism, but no, not in Australia's tax system.
Okay, in the current debate in the media, there's a lot of talk about how this is a tax on unrealised capital gains. Now, for most people like me who their only contribution to super is a portion of their income, how does this work and what is this talking about?
It's one of those things that we often confront in economics where it gets very confusing, and the people who are criticising these changes want it to be confusing because they want to scare the hell out of everybody. A capital gain is basically when the value of an asset that you hold goes up. An easy way to think about it is either shares, or if you've got an investment property, like you bought a house for $500,000 and if you revalued it, got real estate agent come and value it, or if you were to sell it and it's $700,000, well, you've made a capital gain of $200,000, in effect profit. the government is going to tax what they call unrealized capital gains. There are two types of capital gains. Unrealized is just the value of your portfolio, the value of your assets. Realized is the value of them when you sell them. Now, again, I'm saying you only have to worry about this if you've got over $3 million in your account. You also don't have to worry about it if you've got money in a retail or industry super fund. Don't have to worry about these unrealized capital gains because you've effectively already taxed for them anyway, because the way industry super funds work is basically you're a member of a fund and you get a proportion of that fund, and every year your fund accrues in value and in earnings and they get taxed, and you're not there thinking, oh, have those earnings been sold or anything. No, it really doesn't matter at all. It won't change one bit. All this affects is people who have got self-managed super funds and who generally don't even buy and sell a lot of stuff. They've just got stuff in that superannuation fund and it's going up. So under this proposal, let's say you've got a self-managed superannuation fund, you've got a lot of shares in there, some property. At the moment, its valued is $3 million. And in a year's time, the ATO looks at all your shareholdings and your property and says, actually, now that's worth $3.5 million. We're going to make you pay 15% on a portion of that $500,000 that's gone up. And the big difference is in the past, you would have had to sell all of those things, get that $500,000 in cash before you got taxed on it. Now the government is saying, yeah, we're going to tax you even though you haven't sold it.
It's about unrealised gains. Is it really fair to tax gains that haven't happened yet?
When it comes to some of the issues raised by farmers and others, it's already the law that people are supposed to maintain an element of liquidity to be able to meet their tax obligations. And so we know that people have got a view about it. We engage respectfully with the Senate. We would like to pass those tax changes so that we can pay for our efforts to strengthen Medicare and provide cost of living help.
Okay, so the example we often get for these people with self-managed super funds is that a small business owner has the small business in their super, a farmer has the farm in their super. So say one year it's worth $3.5 million as the example you gave. The next year it's worth 3.6. They pay tax on 3.6, but it drops down again to 3.55 the year after. They pay less tax.
Yeah, or they can actually, they wouldn't have to pay tax that following year because they'd actually had a capital gain loss or a capital loss, and they can actually offset that against the next year. So if it goes up $100,000, they can say, yeah, but the year before we lost $50,000, so you can offset that in a sense. And look, there's this lot of this talk is, oh, this is terrible. How can you tax something that isn't real, hasn't actually accrued in value? The problem is that's not how wealth is treated in the real world. If you look at, say, the Financial Review's richest 200 lists that come out, or if you hear things, oh, Elon Musk is worth $80 billion or whatever it is now, I've forgotten how much he's worth, probably $800 billion.
Yep. That's
not $800 billion sitting in cash in the bank. Gina Reinhart, when we talk about her wealth, she doesn't have a money pole like Scrooge McDuck that she goes swimming in. What they're talking about is the value of shares, the value of property, all of her assets. That's how much it is. And no one is out there going, oh, she's actually not that rich. Elon Musk, not really a billionaire because he doesn't have that much in actual cash. It's like, no, that's real money. And crucially, it is real money that you can use to go to a bank and borrow against to invest to make more money. And so when it actually comes to accruing more wealth, we treat it as real money. But then they say, oh, no, you can't tax it because it's not real. It's like, okay, so you're getting all the benefit one way and none of the other. And why the government has decided to do this is because this is one of the biggest loopholes in the whole system. Because currently, if you sold your assets or sold something and actually did realize the capital gain, yes, you get taxed at that 15% earnings. If you don't sell them and they just keep going up and it's nice, you can keep them in your self-managed super fund. They keep going up. The value of your super keeps it going up, and then you retire. And then you go, right, now I'm going to sell all these things. because you've retired, the capital gains tax you pay on realizing that is zero. Big fat zero. So at the moment, the way the system is designed is actually encouraging not just to minimize how much tax you pay, but actually avoid paying any tax. We also give a capital gains tax discount on assets which we've talked about certainly in the past with relating to the problems with the housing sector. If you own an asset for more than 12 months, you sell that for $250,000 profit. Don't worry, you get 50% of that tax-free, $125,000 tax-free. Whereas if you'd earned $250,000 in your wage, you get $18,200 of that tax-free. So there's a real incentive to just have capital gains as your source of income. And the problem is then if you stick it in your super, like you put your farm in your super, and you go, well, why have you got your farm in your super? Why have you got your small business in your super and saying, oh, this is an asset that's accruing in value? Why? Because you don't pay tax on it at the moment. That's why. That's not the reason for superannuation. That's a tax lawyer or a tax accountant telling you, hey, this is a wonderful scheme that the government set up that you can take advantage of.
So you've answered one of my questions about what the hell farms are doing in self-managed super funds in the first place. What about some of what I've been reading, like how a farmer's going to be able to afford this? A farmer who's got a, $8 million farm in his self-managed super fund is going to get a big tax bill apparently. Is this going to damage some farmers?
Well, it shouldn't, because actually, even with your super managed funds, there are rules around what we call liquidity. You should have a certain amount of cash available in your super fund to be able to meet unexpected costs and taxes. So if all these people complaining, oh, this is going to send the war, it's like, are they actually obeying the laws? And also, if you've got $8 million, you've got access to income that's going to meet these tax obligations. I mean, that's one of the reasons why, just in a general sense, we don't tax unrealized gains, because people mightn't be able to mightn't have the cash flow to be able to do it. But that, again, when you've got more than $3 million in your super, and again, that's just in your super, you should have other income. It's not like, oh, I'm just relying on my super. It's like, really? So it's a kind of a bit of a furphy. The problem is there's a lot of lies sort of flowing around this. But also, one of the things that's really given me the irrits about this debate about unrealized capital gains is, again, we're talking about people with over $3 million in super. Let's go right down to the other end of the scale. People who actually are on this age pension, the people who weren't able to save up enough to be able to not have to rely on the age pension. They have to meet an assets test. And if your assets go over those thresholds, you lose pension. And what is that? That's effectively if you hold shares, or if you've got some property, or if you've got some assets and that goes up in value, as in capital gain, you don't sell it, but it's just your assets have gone up in value, Centrelink will reduce the amount of pension you get. And how would they do this? Because if you're on the age pension, you have to tell Centrelink every shareholding you've got, how much you own, and every 6 months they recalculate the value of those shares. If the value of your assets goes up by more than $1,000, your non-financial assets, like you've bought something, an asset that is more than $1,000, you've got to tell Centrelink, because they are tracking your unrealized capital gains. So we're basically saying, if you get, and we're talking $366,000 in assets. If you're a single person who is fortunate enough to own your own home, $366,000 in other assets. If you start going above that, you start losing full pension. So we're saying, that's fine. But at the other end of the scale, if someone with more than $3 million in their super earns $366,000 in a year, oh no, we can't force them to pay tax. That'd be communism. That's the end of capitalism. It's like, so we're applying the rules to the poorest and saying it's unfair that we apply it to the top 0.5%. It really annoys me. And I think this is just trying to address some of the overblown costs of the superannuation. And I think, Glenn, we should talk about the actual numbers. I mean, The richest 10%, these super tax breaks, costs around $22 billion a year just to the richest 10%. $22 billion a year. And if you want some sort of comparison of what that means, the Parliamentary Budget Office this year estimated that to put dental in Medicare, which we're always told, oh, we can't afford that, that would cost $13.6 billion a year. So we're giving $22 billion a year to the richest 10% and then also saying to people, sorry, we can't afford dental and Medicare because that's 13.6. You know, it's this kind of conversation we need to have rather than going, oh no, this you can't tax these poor pensioners. It's like they're not pensioners, they've got $3 billion.
Can I just quickly ask about the way this debate is playing out, the way it's being reported? For instance, I read a yarn in The Australian early in this debate which didn't mention the 3 million threshold. It's about 2/3 of the way down the story. This is being sold to punters out there as we're all going to get some huge extra tax on our super.
Yeah, they're trying to basically replay the whole franking credits lies, making it feel like everyone is going to be affected. And so they're either not mentioning the 3 million or they're focusing on the fact that, oh, that threshold is not indexed. So in time, we're all going to have more than $3 million in super. We're not. You know, even sort of the loudest critics are suggesting maybe in 30 years about 10% of people might have 3 million in super. You know, you can go on the government's website, Money Smart, and actually work out how much super you're probably going to end up with and put in all sort of calculations of what you'd need to get 3 million. You have to earn well above, you know, you have to be earning in the top 10% of incomes from about the age of 18 all the way through, never have time off, never take time off to raise kids, never leave to go study, and keep getting a 3.7% wage rise every single year to get even close to $3 million in 40 years.
Never mind that there'll be 10 parliaments between now and then, and you can't tell me a coalition, opposition or even sitting government's not going to go, oh, we're going to raise the threshold to 3.54.
Yeah, I mean, 40 years ago, the top tax bracket was $35,000, you know, and no one back in 1985 was going, oh, geez, we better raise this, or in 2025, we're all going to be earning $35,000. It's like governments come along and decide, actually, I think there's worth in raising it, or an opposition will say, we're going to raise the threshold, and the government will say no, and people go, actually, we like what the opposition's doing. You know, and this lie that thresholds are stuck in, you know, stone is just doesn't accord with reality. And also, again, if people were saying, oh, it should be indexed, I'm like saying, so you think really 0.5% of people having to pay more tax, that's the limit of our ambition. If it gets to 1% in 5 or 10 years, that's suddenly terrible. It's like, no, actually, I think that's probably a good way to do it. It gives people time to, you know, work out what's going on, rather than, oh no, we always think it's fine that 99.5% of Australians, you know, don't have to worry. It's like, you know, let's have some ambition. But even still, as you point out, what, in 10 parliaments, in 40 years, nothing's going to change? Of course it is. So it's a dumb argument, but it is being used very effectively. The good thing for the government is it's not like they have to negotiate with anyone except the Greens. The Greens are actually saying, how about $2 million for a threshold? But they are saying, set it at $2 million and index it. I think the government will say, thanks, but no thanks. They might index it if they are a bit scared of that, but, you know, they can always change that later. The key thing is, you know, $22 billion in tax breaks going to the richest 10%, designed to help them not be eligible for an age pension that they'll never be eligible for. That's money that could be spent on schools, roads, dental and Medicare, things that actually will help a majority of Australians or all of Australians. And instead, we are falling into this trap of thinking a tax that might raise about $2.8 billion, not even close to most of that $22 billion, is somehow the worst thing that's ever been devised. And it really is completely not that.
So just to wrap up then, while maybe it's because the election's been run and won comprehensively and News Corp's got nothing to shout about. But rather than running a scare campaign, this should be a conversation about inequality.
Yeah, absolutely. It should be. And I think one of the reasons why we're getting this scare campaign is that the wealthy and the vested interest groups are a bit worried that people might look at actually just how bad the system is and go, oh, yeah, we can't tax unrealized capital gains. Why? What's happening with capital gains? Oh, my God. 80% of the benefits of capital gains are going to the richest 10%, Millionaires are getting 40% of all the capital gains. That seems a sweet deal that I'm not getting as a wage earner. And they clearly don't want you to turn over that rock and just see what's hiding underneath it. So they're trying to do the scare campaign of, oh, we're all going to be worse off because of this. And it's like, the difference with franking credits, people were like, do I have franking credits? Do I get them? Maybe I do. Oh, maybe. Whereas, if you got $3 million in super. And to be honest as well, if you're ever going to have $3 million in super, because I can tell you, if you look at your super and go, geez, that seems pretty low, believe me, it doesn't matter how wonderful investment is and everything, you're not going to get there. If you're going to get $3 billion, you already know that you're on the path of $3 billion because you got a lot of super. All the rest of us, sorry, we're not going to get there. But hey, we're not going to have to pay more tax, or we're not going to get less of a tax break. So stop worrying.
Thanks, Greg.
No worries, Glenn. Great to chat.
You can order your copy of our inaugural Vantage Point essay. The first edition, After America, Australia and the New World Order by Dr. Emma Shortis, is out now. You can purchase the first edition or become a Foundation subscriber to the Vantage Point series via our website, australiainstitute.org.au/store, or tap the link in the show notes. This episode was recorded on Tuesday, the 27th of May, and some things may have changed since recording. We'd love to hear your thoughts on the show today. You can reach out to us via email at podcasts@australiainstitute.org.au, or you can find us on social media. We're at australiainstitute.org.au on Blue Sky and at the Oz Institute with an AUS on Instagram and Twitter. Our theme music is by Jonathan McFeet from Pulse and Thrum, with additional music from Blue Dot Sessions. I'm Glenn Connley. Thanks for listening.